So first of all, let me talk about what is an index. An index is a broad basket of equity or bonds that represent a target exposure. A very good example of it is MSCI World Index, which aims to capture the developed markets equity exposure. So it's made up of 1,500 stocks from 23 developed market countries. So and then what is index investing? So index investing is a systematic process to replicate a benchmark index as close as possible. So for example, if the index go up by 1%, the index fund should also roughly go up by 1%. And if the index go down by 1%, the index fund should also roughly go down by 1%. Unlike active manager, the manager of passive management does not aim to take active decision in terms of stock selection and asset allocation within the fund. And there are three appealing factors for index investing. Number one, it is low cost. So compared to active managed fund, it is much less labor intensive for passive fund. For active managed fund, maybe you will need financial analysts to do financial analysis of each companies, and also you will need to pay manager visit. You will have to visit the companies in order to assess the companies and then to find the right stock selection. But for passive manager, our job is simply to replicate the benchmark as close as possible. So less labor intensive translate to less cost in that sense. According to Morningstar, in 2021, and the average fee of an active manager is 0.6%, while the average fee of a passive manager is only 0.12%. The second factor is simple, quick, and precise access to target exposure. With a simple execution, investor can get access to a benchmark index with hundreds and thousands of equities or bonds. Investor can also select different trading counters like US dollar or Sing dollar. And number three is really the transparency of how the fund is managed and how the disclosure were made. Index fund checks the benchmark index, so there's no hidden secret. The information of the index, the holding, and the performance can be found easily on issuer's website. So to recap, there are three distinct advantages of index fund. One is low cost. Second, it provides simple, quick, and precise access to target exposure. And number three is transparent. So it's the ideal tool for long-term investment. Right. Investment fee has a big impact to your return from the portfolio. This is even more significant for long-term investor as the impact of the fee will be compounded up over the years. So to share with you one simple example, if you're retiring in 30 years and you're investing $10,000 per year, assume that you invest in S&P 500 index that gives you about 12% annualized return per year. By the end of 30 years, if you invested in an index fund that charge you 0.05% management fee, you will receive roughly 2.39 million of asset. In contrast, if you invest in an index fund which is more expensive, say 0.5%, with all else equal, you will only be receiving 2.19 million of asset at the end of the 30 year. So there's a $200,000 difference at the end of 30 years. Consider that you only invest $10,000 per year, the difference is very significant. So it's important for investor to select a low-cost product in terms for the passive investment. So how Amundi keep our costs low? So there are two key reasons. One is economy of scale. Amundi is one of the largest asset managers globally. We manage more than 1.8 trillion of assets. So we have a lot of economy of scale in dealing with external service provider to get a better arrangement and get a better pricing. Also, Amundi internally, because of the economy of scale, we can share our costs better, like our back office function, and also we can share our marketing expense in a much better way for a wider asset base. So apart from the economy of scale, Amundi can also keep our costs low by selecting our index provider carefully. So we can look up for innovative index provider, negotiate a better pricing, and translate the cost saving to investor in long run. Right, US remains the largest single equity market globally. It makes up more than 66% of the MSCI World Index. So it's important for investors to remain invested in US equity market for the long-term investment. In a very volatile market like 2022, we advise investors to stay focused on their long-term investment goal and keep a very well-diversified portfolio. We believe a well-diversified portfolio can help investors to weather better the up and down in the market. Meanwhile, index investing is a very efficient tool for investors to achieve instant diversification by accessing hundreds or thousands of equities and bonds within the indexation.